Why this business and why right now?
Well, this is a transformative deal for us. I mean, it's really a perfect fit. It does really exactly what we do in the United States in our fire safety and security business. We're the largest in the U.S. in that business. This is the largest player in Europe and in a variety of other markets like Australia, Hong Kong, and elsewhere. So it really is a marriage of two leaders in their respective markets doing the same thing. And it'll enable us to have really a lot of scale opportunities, synergies, go-to-market strategies, all kinds of things that really makes 2 and 2 make 4. Really, 2 and 2 make 5, I should say, in this situation. So we're very excited about it. It's something that we had planned on doing to really grow the business since we made the acquisition some time ago of API, and this is the next step in our evolution.
Martin, obviously the business, just looking at it on paper, has slightly lower margins than the existing API business. Firstly, are you going to be able to close that spread between the two? And secondly, how accretive is it even without improving those margins?
So the math's actually pretty interesting. It's about, we've said on our call earlier on today, a little over 25% accretive to earnings per share on a trailing basis. The reality is, it's really not about that. This is a business that today has just short of 10% EBITDA margins at Chubb. We think that's a 14+% EBITDA margin business long term. That's like our fire safety businesses in the US. So we think there's a long-term margin improvement opportunity. So the math is very compelling, but more importantly, the strategy is a great fit for us. Plays to our core strength.
And talk a little bit about Russ Becker, who obviously was the CEO when you guys came in. You did the SPAC deal to take API that was then private public. A lot of those deals we've seen, people have come in, they've changed the existing management, they brought in their own people closer to the traditional private equity model. You've kept him on. I wonder, is this a sort of repayment of that faith that he's now allowed to go out and execute a very meaningful transaction for this company?
Well, I tell you, Ed, it's actually very different from that. We actually came into that transaction because we wanted to back Russ and the team. And their culture and the way they operate is very similar to how we built Jarden Corporation over the long term. You know, Jim Lilly and I and Ian Ashkin. And the reality is they're following the same path. So our intention was always to back Russ. I wouldn't say this is just an award for him. And the reality is we've been doing this together. Our job is to really help him do the M&A, the transformative M&A that that he's frankly never done before. They've done a lot of smaller transactions. This is obviously a larger transaction. So it's a very good marriage of our strengths and his. But he really knows how these businesses should look and how they operate in this space. He's been doing it for a very long time. He built API Group over the last 12 years as its CEO. So we feel very comfortable from an execution standpoint, and where we play a role is obviously assisting him from the transactional area.
So Martin, we've talked a lot before about the SPAC deals that you've done. You're widely considered the godfather of the SPAC. And the importance of pipes. And now in this deal, you've got a couple of investors alongside you. Blackstone Group and Viking Global are buying perpetual preferred equity. Why is it important to you to do deals like this?
Well, I don't think of this in terms of the SPAC world. I mean, this is a, if you like, regular public company that's way past its sort of period of being a SPAC. We would have needed a pipe to do a transaction of this side in any scenario, and we needed about $800 million of additional equity to feel we could do this and keep our balance sheet conservative. Why Blackstone? Why Viking is obvious. They're already our largest shareholder and great supporters of the company, and they've been fabulous investors and supporters for us at API. As for Blackstone, they had a strategic interest for some time in Chubb. They'd looked at it themselves, and marrying together our capabilities and the fact that we have real synergy from an industrial standpoint, combined with the fact that they own an awful lot of real estate,
right,
where we'll have the opportunity to service them in their buildings. That's just icing on the cake from our perspective.
I didn't mean to paint this as a SPAC or compare that really to a pipe. It's just the idea of investing alongside experienced partners like this? Do you prefer to do deals like that?
You know, I'll go back to a transaction we did in Jarden, what must be 15 years ago now, where Jarden bought a company called American Household. And the analogy to the Chubb deal is actually uncanny, because it really took us from being a very US-centric business to being a truly global business. And in that deal, it was a large transaction. It had lower than fleet margins with an upside opportunity. And we brought in Warburg Pincus, and Chip Kay joined our board at the time, who's the CEO of Warburg Pincus. And it was a win-win for both of us. In that case, we brought in about $350 million in a pipe. So here it's a similar situation, and David Blitz is going to come on our board, who runs TACOP's part of Blackstone. We're very excited to have him on board with us. And their expertise is going to be a tremendous help to the company.
Martin, just before we let you go, I've got a last question on SPACs. As Matt alluded to, you have done a lot of them. Obviously, this isn't a SPAC deal. Do you think the model itself is going to survive and recover from what has been a pretty severe reputational mauling over the last few months?
Look, it's exactly what I've said for a long time it's going to be. It got way overdone. It got abused. People have gone over their skis and done things they probably, are just unwise from an investor's standpoint. A lot of bad companies, in my view, have been taken to market, and there's going to be a digestion period. Do I believe in the SPAC model and that there are constructs to make it work phenomenally well if you're a responsible investor and know what you're doing? Absolutely. And I think that's going to be here to stay. But there's a big shakeout that's actually in process, and it's going to continue. And, I've always liked the structures where there's great alignment with investors. And, I'm very proud of the fact that the companies that we have in the market are not companies where we got free shares, but we got rewarded when we created value for shareholders. And that's really how it should be. We never took any fees and, all of this crazy stuff that's going on right now. There needs to be a correction. And frankly, the adults in the room who should know better are the people who buy the pipes. I've said this for a long time. But, that's their business. And, when these stocks go back down, they get punished for it.